when I see investors pulling $17.5 billion in global equities out, I start asking myself, where are they planning to take that capital? What do they see and what is happening? Hi, my name is Rob Swanson, and if you love the idea of designing your life, you're in the right place. This is the show about real estate, money, and life to get you motivated and help you navigate the road to freedom. Whether you want to start investing in real estate, scale your business to the next level, or sit back and reap the rewards from passive income, I'm here to help you achieve freedom in all areas of your life. So now, sit back and enjoy. This is the Real Estate Mogul Podcast. All right, everybody, Rob Swanson back here with another episode of the Real Estate Mogul Podcast. Hey, in today's episode, we're going to be talking about value investing. We're going to be talking about applying the strategies of value investing to build a real estate portfolio. Now, these strategies can be applied to building almost any kind of investment portfolio. We're going to take a curve and we're going to specifically talk about real estate and how the strategies of value investing can be applied to help you build your cash flow, and portfolio position. Now, as I get us started, I want to make a statement. And this is something that I think about long and hard, and especially over the last decade or decade and a half. And it's this comment: tailwinds create great investments. Headwinds expose great investors. Now, let's break that down for a minute. Tailwinds create great investments. That's the first half of this comment. And what that means is when you have outside forces, when you have outside market forces, outside capital forces, outside economic forces, outside governmental forces pushing you forward, tailwinds create great investments. Now, on the flip side of that, headwinds, when you have economic headwinds, when you have financial headwinds, when you have governmental headwinds, when you have market headwinds pushing against your path, the most successful investors that can stand the test of time and get through those headwinds are the great investors. Everybody is a genius in a bull market. And the past decade has absolutely shown that to be true. Everybody has come out and created their posts on social media talking about how great of an investor they are. They've come out with their YouTube channel. They've come out with their podcast. They've come out with their newsletter or whatever the case may be. And the reality is, so many of these people have only been an investor in a bull market. So when the bear market shows up, when the headwinds show up, what is going to stand the test of time? Is their strategy strong enough to stand the test of time? Now, what I want to do is I want to tackle this conversation from a few different angles. And what we're going to do is I'm going to break down what I think the multi-pronged approach to real estate investing is right now. Okay, in the world today, as we see it, what should you be doing? That's what you're going to walk away from this episode with, is a plan, a strategy, and a thought process to help you think about tackling the real estate investing game where we are today. And let's just talk about where we are today, right? We've come through the last few years where many of us couldn't have imagined the headwinds that businesses and people and investors and families have had to push against over the last couple of years. Let's look at the last decade. Since the crash of 2008, it's been nothing but a bull market. Now, let's talk about why it's been a bull market. It's been a bull market because of this term called quantitative easing. And it's been a market because quantitative easing is basically the government or the Fed, which, by the way, if you don't know, the Fed is not a government entity. It's a private entity. pumping money, quantitative easing is pumping money into the economy. See, the Fed has a handful of ways that they're chartered by Congress to control the economy. Number one, they play with interest rates. So if the economy is heating up too fast, they increase interest rates, they cool it off. If the economy needs a little shot in the arm, they lower interest rates and they kind of speed the economy up. All they're doing with interest rates is they're controlling the flow of money, of the currency, into the hands of businesses and people. So interest rate adjustments is the number one tool that the Fed uses to charge the economy or slow down the economy, charge it up or charge it down. The second tool that they have is this thing called quantitative easing. And basically it's printing money. Okay, it's increasing the supply of currency into the overall market. And so when they increase the flow, the creation of currency and flood the market with new currency, fiat currency is not backed by anything, it's just paper, they're effectively devaluing what the dollars or the currency that exists today by creating and printing new. But that's one of the tools that the Fed has in their arsenal, and it's one of the tools they use to stimulate and move the economy. So number one, they control interest rates up or down. Number two, they print money, quantitative easing, and they use that money for bailouts. They use that money for programs. They come up with all sorts of ways to print currency and get it into the system. Okay. Now, this third thing that the Fed uses to control the economy is only used when the first two are out of juice. It's only used when the first two are out of juice. And that is to put stimulus directly to the people. Friends, what have we seen over the last couple of years? Stimulus directly to the people, right? You did nothing for this money that showed up in your bank account. Nothing for the money that showed up in your bank account. When the Fed gets to that third trigger, we know that there's a problem. We know there's a storm brewing. And that storm is, this is the thing I want you to understand. Bankers make and bankers crash markets. And so I get asked all the time, can you predict the market cycle? And I have gone as far as on Facebook, writing a post and publishing this out there, saying I will predict the exact time and day that the market will crash. And I'll let you go find that on Facebook and read it. But it isn't so much the exact day and time. It's when certain things match up. It's when certain things have taken place where the currency can take its final dive. Okay. So I believe that the crash of 2008, and I successfully went through the crash of 2008. I didn't get hammered in the crash of 2008. In fact, the crash of 2008 created some of the greatest years for me as an investor because I took a value investing approach. And we're going to get into that in a moment. But because I took a value investing approach and I looked for hidden value, value that wasn't there or value that was being undervalued, I was able to cash in on the crash of 2008. Now, taking us all the way to where we are today, then, we've had nothing but a bull run since the bottom of the crash, and that bottom of the crash probably dipped out in 2011 or so, somewhere in there, was the bottom, and then it's been an upward run for the last near decade. And that bull run, that upward run, and I'm talking about real estate values, just the heat of the market, rental rates going up, cap rates going down. There's a flood of money, currency, liquidity, money, capital into the market that wants to go into real estate and has been going into real estate for the last decade. And That has continued, and it's going to continue until it stops. And you've always seen, when the music stops, somebody's going to be stuck without a chair, right? And so I consider and I think about three things. I think about the three things that drive the economic storms that drive a crash. And I've looked at this historically over the last few decades, going back to the crash in 73, 74, going back to the crash in the late 80s, 90, 91, and then the crash in 2008. They were all driven by liquidity problems, lack of liquidity in the market. So bankers making and crashing markets. And there were three perfect storms that came together each time. Number one was a presidential transition. Okay, so where we sit today, we've just seen that. Okay, so there was a presidential transition preceding each of the last three crashes. Number two, there were financial policy changes. Okay, look at what's been going on. Watch the Fed, watch the bonds market. There are financial policy changes that have been taking place over the last couple of years that have printed money, more money has been printed in the last 24 months than any time in history. And the numbers are astounding, right? The currency has been massively devalued. And that's why we're seeing inflation. That's why you're seeing prices of houses go up, right? If you're seeing gas prices go up and you're watching house prices go up, it's the same thing. Okay? Commodity and asset price appreciation is driven by the policy of quantitative easing, or printing and putting so many new dollars into the system. It forces, through supply and demand, it forces asset price appreciation. So if you look over the last decade at some of the largest investors and what they've done and how they've approached their investment strategy, they understood these things. Now, what's interesting is, and there was a Market Watch article that came out, and it talked just the other day, and it talked about, it reported that Bank of America reported that investors pulled, now get this number, investors pulled $17.5 billion out of global equities in the past month, making it the biggest outflow this year. Okay, global equities investors took $17.5 billion out of global equities. That's the biggest outflow. That's taking money out of the market. That's moving to a cash position. Now, you have to ask yourself, why would they be doing that? And as a value investor, I want to be thinking about, okay, what is a value investor? What is one of the most important things that a value investor thinks about? Besides risk and upside, they think about opportunity. And so what a value investor is looking for is, a value investor will make a decision to sell an asset when he or she believes that he or she can liquidate that asset, go into cash, and then buy something at a more valued position, cheaper, with better terms, greater cash flow, undervalued, bigger upside. So an investor looks for that type of opportunity. When I see liquidity being pulled out of the market, when I see investors pulling $17.5 billion in global equities out, I start asking myself, where are they planning to take that capital? What do they see and what is happening? So if we go back, let's talk about the third of the storms, stock market turmoil. So we had presidential transition, we had financial policy change, and we have stock market turmoil preceded each of the last three housing market crashes. Now, I do believe that the next crash we experience, the next downturn we experience, is going to be a currency-driven crash more so than a debt-driven crash like we've seen the last three crashes, back to the 70s, the 90s, and the 2000s. Okay. The next crash is going to be more a currency-driven crash, the devaluation of the currency. So what do you do as a value investor? What do you do to protect and hedge yourself? Well, you get out of cash and into assets, but you look for the time of that and you're always asking yourself, am I in assets today that I could liquidate quickly, go into cash and move quickly back into another asset? So we're going to get into, in a couple of minutes, talking about how should you be thinking about the market today and what should you be planning for and strategizing for. See, because of quantitative easing, because of the Fed's three things that they do, adjusting interest rate, printing money, and then stimulus, it's hard to predict the downturn when markets are being manipulated and propped up to survive. So as a value investor, you often look at your assets, you look at your portfolio, you look at what's going on outside of your control, the market, the various market, financial, governmental forces, and you ask yourself, do I stay in this asset today or do I liquidate and do I move into another asset? Is there an opportunity coming? Because as a value investor, he who sits in cash has the opportunity to strike when the iron's hot. And so there's a balance, because today with the printing of the dollar, cash is being devalued every day. If you're sitting in cash, the dollars are worth less. And so it's an interesting time to be a value investor when historically it's been debt crashes, but looking forward, it appears to be more of a currency crash. So how do you balance the selling of assets and the timing of selling that asset, going into cash and getting that cash redeployed in a better performing asset? You don't want to be holding the bag at the moment that the currency devalues. You don't want to be holding and sitting in cash. So there's a strategy and there's a thought process that you have to ask yourself, how much of my portfolio do I want to leave in assets? How much do I want to liquidate, take out, and have as opportunity striking dollars to take advantage when the market does dip or you see a value asset that you can buy that's performing better? So, do you have what it takes to build a successful real estate investing business or scale your existing business to the next level, but you feel like you've hit a brick wall and there's something holding you back? If you answered yes, then my team of experienced real estate investor business development consultants wants to talk to you. This is your opportunity to get paid while you learn the business. But this is not a coaching program, it's not daycare or mentoring. It's hands-on learning where you'll put in the work and we'll guide you through every step to split deals and make money together. I'm always looking for ways to expand my real estate investing business into new markets, create more passive income, and expand my hard money lending business. And my team of professional real estate investor coaches are always looking for ways to make more money by helping students close more deals. So we put our heads together and decided to bring on a small number of apprentices each month. This isn't for everyone, and there are a few requirements to being accepted into the program because this is the only program that we get paid on deal splits. If you're ready for the next level, are ready to join our success team, work directly with one of the experienced real estate investors on my team, and you're willing to put in the work and follow our guidance, go to realestatemogul.com/success to learn more. You'll learn what I'm looking for, how the program works, what you get from us, and what we'll expect from you. So do it right now. Go to realestatemogul.com/success. So let's talk about value investing for a moment. So value investing, and I'm going to just give you a phrase and then I'm going to break this down. Value investing. Now, in particular, in inefficient markets or real estate, is high return and low risk. Value investing in inefficient markets, like real estate, is high return and low risk. Now, why is that? Because value investing at its core is buying below a market value. So you're going to buy below a market value. Now, the reason I said in inefficient markets like real estate, and I'll define what this is in a moment, is because an inefficient market is what creates the opportunity for the individual investor. So value investing requires that you as the investor be more disciplined in your analysis of risk than your analysis of return. As a value investor, I like to buy at a discount, right? And I like to look at that discount. Is that discount based on value? Is that discount based on cash flow? Is that discount based on a poor performance? What is the root cause of the discount, right? Warren Buffett's famous line is price is what you pay, value is what you buy. That's a statement of a true value investor. Price is what you pay, and value is what you buy. Now, sometimes the reason you can pay the lower price is because of certain mismanagement. There's something that's been mismanaged, whether the condition has been mismanaged, whether the occupancy has been mismanaged, whether the market rate cash flow has been mismanaged. Something has been mismanaged. Now, it doesn't always mean that there's been mismanagement. Sometimes there's a third-party problem. There's an ownership problem, dispute between partners. There's been a death amongst partners. There's been something that is driving the price value discrepancy. But as value investors, that's what we look for. We look for the ability to solve problems as a value investor by paying a lower price or with better terms than what the value is today and can be in the future. So on a side little note, I did a masterclass in my home office with my family, with two of my kids. My wife and one of my son's buddies was over at the house, and it was about 9 o'clock in the evening, and we were sitting around in the kitchen talking, and something came up, and I said, okay, let's go to the office. So we walked over and went into my home office, and up on the whiteboard, I started to break down the analysis of a deal scenario in different conditions or in different phases. So we looked at the deal scenario and we took a 100-unit apartment complex, and we said, okay, 100-unit apartment complex, 100 units are rented. It's rented at full market rate. The property's already in fixed up good condition, and this is the top peak performance. That was our control analysis. Then we started to look at, well, what if it's just rented at full occupancy, but it's under rented below market performance, but it's already fixed up. So the only adjustment we made was it's under market rent, fully occupied, condition is good, but it's under market rent. That was scenario 2. And we asked ourselves, what would we be willing to pay for each of these assets? The third scenario we looked at was the same, but now there was an occupancy problem. It was only 70% occupied. It was under market rent, but it was still in good fixed up condition. But now we had 2 points of value creation, of opportunity that we could sort of lean in on to get our price, to justify our price and create the value. And the fourth scenario was the same exact apartment complex, but now we said it's 70% occupied, it's under market rent, and it's distressed. It needs work. So from the highest price that we would be willing to pay, the maximum allowable offer as a value investor, all the way down to the lowest price that we would be willing to pay, basically analyzed the risk at every step, fully occupied, full market rent, fixed up condition. That's the highest, or that's the lowest risk. That's the highest price we'll pay. The highest price, lowest risk. And then every one of those scenarios inserted one more element of risk that we as the value investor had to take on and fix in order to extract the value out of that particular property. So we sat in my home office and we spent some time going through this, and I had literally, again, my wife there, two of my kids, and one of my son's buddies, and I had all of them pull out their calculators on their iPhones, and we just ran simple math. And by running and understanding simple math, we were able to determine what could we pay, why would we pay that, and how as a value investor do we adjust for risk. So I'm going to say this again. Value investing requires that the investor be more disciplined in your analysis of risk than in the analysis of the return. So what we did, and if you've listened to one of the previous, more recent podcasts, I talked about how neighborhood grade affects risk and affects your decision-making process when you're buying a real estate asset. So what we did is we looked at the neighborhood grade, the neighborhood that this particular 100-unit apartment complex was located in, and we asked ourselves this question: how do we want our money to perform? As a value investor, we said, what cap rate would we want to buy this asset at in order to provide us the appropriate adjustment of risk and purchase of value? And so we came up with a number, and we used that same cap rate to calculate our maximum allowable offer on each of the three scenarios. But then once we got to that fourth scenario and we inserted a condition problem, like the property was distressed, we increased the cap rate to give us a greater margin of safety against that risk. The risk of having to fix up the property. It's going to take more time. It's going to take more capital. It's going to take management. It's going to take all of these components to manage the repairs. And so we increased the cap rate, which lowered our maximum allowable purchase price to adjust for that risk. Now, let's go back and break down this idea of value investing in inefficient markets like real estate produces a high return in low risk. Okay, value investing is very disciplined. I know how I want my money to perform. I know what margin of safety I want in my investment portfolio. And so let's tackle this word inefficiency for a minute. So inefficiency basically means that there are opportunities for the individual investor without having to, quote unquote, buy the market. And in an efficient market like Wall Street, right? Like your 401k, like your mutual funds, like playing the market, you're buying market price. Now, good investors have the ability to look at an efficient market and find underperforming assets, underperforming stock prices in an efficient market. Okay? Most investors, and in particular real estate investors, aren't playing at that level, aren't playing in that type of a capacity. Most investors, and this is where the inefficiency of the market comes into play, you can find those value opportunities in an inefficient market oftentimes easier than you can in an efficient market, because everybody gets to play in an efficient market. And so prices are generally retail. You're paying what the market says you need to pay today. Now, again, good investors have the ability to look into different segments of the market, into different opportunities, into different companies, into different categories, and find that divergence from price and value. Maybe there is a company, a stock that is undervalued in an efficient market. It's fewer and harder to play. And the masses of investors, your 401k, your mutual funds that you buy, your S&P 500s, your large cap stocks, those are very efficient. And those are, you're paying premium price. You've got to get into some of the small cap, some of the smaller opportunities to find those inefficiencies. Now, in real estate, however, real estate is an inefficient market by nature. And it's inefficient for a variety of reasons, right? It's inefficient because the market itself is fragmented, right? There is no quote unquote stock market for you to just go buy your house, okay? It's a transaction between a seller and a buyer. So it's very inefficient, but that inefficiency is what creates the opportunity to pay a price that is below the value. And that's what creates the opportunity. That's what creates the opportunity as a value investor. So you're looking for inefficiency. Now, value investing is then also looking for and being able to identify the value add that you or your team can bring to an underperforming asset. Okay, so you're looking in an inefficient market, which gives you an advantage, and you're looking for the value added opportunity. You don't have to pay the market price because not everybody is looking at the same deal, right? When you see a stock ticker, everybody is seeing the price. When you use your skills as a real estate investor to go shop and search in an inefficient market, you could be the only investor looking at that deal at that particular time. And that gives you opportunities to create greater value. So when you combine, number one, the value investing and considering risk, making your adjustments, determining the value that you want to buy for a certain price, and then doing that inside of an inefficient market, that's what creates higher returns and lower risk. Now, this is all simple in theory, but it requires discipline, patience, and skill in practice in a big way. See, value investing requires that you be willing to look at a pitch and not even take a swing because you're patient, right? Inefficient markets improperly value assets more often than efficient markets do. And it comes down to a couple things. Like I said before, poor asset performance, many times from mismanagement, and then from supply and demand imbalances from either an inadequately sized or a fragmented marketplace. That's what makes real estate interesting. And again, playing in those two things, that value investing approach with an inefficient market requires that you, the investor, go dig up and find deals rather than simply clicking the buy now button. So you combine true value investing with an inefficient market, and you can buy those higher returns at lower risk. That's how value investing works. Now, I'm just scratching the surface on the things that we can talk about and how you approach this. But I want you to understand value investing at the big picture level, and I want you to be able to apply it to, okay, where we are in the market cycle today, right? The last three market corrections, crashes have been debt cycle driven. Going forward, it's likely to be more currency driven. And so you as a value investor need to ask yourself, how do I make my buying decisions today such that the value I have bought today is there, if not greater, tomorrow, even when that correction happens? So here are the things that I think you should be thinking about and how you should be taking a multi-pronged approach to real estate investing today. And there are 6 things in particular that I want you to think about as you're building your strategy and investment thesis going forward. Number 1, don't try to anticipate a 1 to 2 or 3 to 5 year horizon. Where we are in the market cycle with high prices, tons of currency being printed, asset price appreciation through the roof because of inflation, and prices being as high as they've ever been, you need today to plan for a long-term horizon only. Don't plan for a short 1 to 2, 3 to 5 year horizon. If you plan for a short-term horizon, you could end up needing your exit right when the bottom falls out. So number one is plan for a long-term horizon. That's the advice I would give you today. Have a long-term think going on inside of your head. Number two, buy at a discount sufficient enough to protect against a correction. But here's the key. Don't worry about values going up or down. Okay? Don't worry about values going up or down. Make your analysis, make your buying decisions in such a way that you're thinking about, if the market goes down, if there's a correction, am I still protected? Okay. Have I adequately hedged my price against the value such that if the value goes down, I'm still in an okay position? And then don't look at the daily, weekly, or monthly ups and downs of value. Okay. That's number two. Number three, buy based on a conservative cash flow. Okay, again, I want you to consider a correction. And depending on the asset class, and this is important, rents historically go either up or down in a crash. So you need to know how rents or cash flow is expected to perform in the asset you're investing in. Okay, so from single family houses to multifamily to say mobile home parks to storage facilities to any type of real estate that cash flows, and then considering its market position, the neighborhood it's in, the grade of property, all of those things, you want to be asking yourself, in a correction, is cash flow going to go up or is cash flow going to go down? This is hedging your downside risk at the beginning when you buy, right? So that's number three. Buy conservatively based on cash flow. Now, I've been saying this for a number of years, and it's allowed me to buy continued good assets. There are people that tell me all the time I'm too conservative, that I should buy more, that I should do X, Y, and Z. And guess what? Maybe they're right. But I have an investment approach. I have a thesis. I have a discipline that I've built over the years, and I've exercised that muscle, and I'm comfortable with the way I'm tackling it. Do we miss some upside? Maybe, but we capture upside while being hedged against a major downturn. So I'm okay with it. I go back to the conversations that I had with people in 2005, 2006, 2007, when I sold much of my portfolio of single family houses in 2006 and early 2007. Everybody told me I was crazy. They told me, oh, it's going to continue to go up. You're leaving so much money on the table. You shouldn't sell now. You should continue to hold. Well, I made a decision back then as a value investor to get out of that debt into cash, be liquid, and that turned out to be a really good decision. So as a value investor, one of the things that you look for is you look for those pivot points, that are those transition points between the up and the down. There's a point, there's an inflection point if you study markets and study value investing where things are going up and then all of a sudden they go down. And it's in that inflection point, that period in the middle, where you see a lot of volatility. And it's when you begin to see volatility that you can begin to anticipate a change in market direction. So I'll give you an example. In real estate, if values are just going up and cash flows are just going up, and they're going up and up and up and up and up and up, and days on market in the retail side of the market are low, and housing prices are being bid up in the retail sector, and There's not much rental inventory. There's consistency, right? It's moving in a similar direction. As soon as you begin to see some of these indicators start to become volatile, and all of a sudden, rents have been steadily going up, but all of a sudden you're starting to see them dip in certain areas. Days on market start to extend a little bit in certain areas. Like there's not the consistency across the market. When you see the volatility, you can begin to anticipate a correction and a change of direction, because then you see a steady, low volatility move back down. So you see steady, very stable moves up. You see a high period of volatility where people are starting to ask the questions, what's going on? Hey, are houses sitting on the market longer? Yeah, why do you think that is? All of a sudden, you can see these conversations of volatility. Watch the news media. You'll get a sense of the market sentiment by watching the media. And then you'll see either a very cliffed downturn or a steady downturn that happens over time. That's the inflection point that you want to be looking for. Number 4, because of that, buy with patient capital. Buy with capital that doesn't have a 2 or a 3 or a 5-year balloon trigger. Buy with patient capital that's willing to go along for the ride. And buy with patient capital that allows you to look at this and say, I can sell an asset today and we can make a better value investment over here. We'll increase our returns. Buy with patient capital that lets you manage effectively your strategy with inside the discipline that you project. Number 5, be patient in your placement of capital and your selection of assets. And this is key, right? Don't just buy for the sake of buying. I want you to buy for the sake of performance. I want you to buy for the sake of risk protection. I want you to buy for the sake of hedging and balancing what you're doing in such a way that you set yourself up for success. Number 6, strengthen your discipline muscle and adamantly stick to your investment thesis, even when you look and see others appear to be crushing it. Because guess what? Those guys that were crushing it in 2007, 2006, 2005, that were telling me I was too conservative and that I shouldn't have sold, well, those are the same guys that went bankrupt in 2008, 2009, 2010 and lost everything, right? They were riding this market up. When the volatility began, they didn't see it. They didn't pay attention to it. They thought, it's just a quip. It's just a blip. It's going to go by. They didn't understand that volatility was an indicator of a market direction change. So these are the things I want you to be thinking about. Play for a long-term horizon, buy at a discount, conservatively value your cash flow and hedge against a correction, buy with patient capital, be patient in your placement of capital and your selection of assets, and then strengthen your discipline muscle and stick to it even when others appear to be crushing it. Friends, if you do that and you understand where we're headed going forward in the market, you can build a successful real estate portfolio, a successful real estate investing business today, regardless of what the market's doing. You got to pay attention to the outside. You got to pay attention to those headwinds and tailwinds. And if you can ride the tailwinds and succeed into the headwinds, not only will you enjoy the benefits of great investments, but you will emerge as a successful investor. Friends, this is Rob Swanson. We'll see you in the next one. Bye-bye. Do you have what it takes to build a successful real estate investing business or scale your existing business to the next level, but you feel like you've hit a brick wall and there's something holding you back? If you answered yes, then my team of experienced real estate investor, business development consultants wants to talk to you. This is your opportunity to get paid while you learn the business. But this is not a coaching program, it's not daycare or mentoring. It's hands-on learning where you'll put in the work and we'll guide you through every step to split deals and make money together. I'm always looking for ways to expand my real estate investing business into new markets, create more passive income, and expand my hard money lending business. And my team of professional real estate investor coaches are always looking for ways to make more money by helping students close more deals. So we put our heads together and decided to bring on a small number of apprentices each month. This isn't for everyone, and there are a few requirements to being accepted into the program because this is the only program that we get paid on deal splits. If you're ready for the next level, are ready to join our success team, work directly with one of the experienced real estate investors on my team, and you're willing to put in the work and follow our guidance, go to realestatemogul.com/success to learn more. You'll learn what I'm looking for, how the program works, what you get from us, and what we'll expect from you. So do it right now. Go to realestatemogul.com/success.